First of all, financial technology is a concept or a subject or a topic, if you like, that has been in the news for quite some time, in the past 5 years, I would say. So it's been very popular as a topic. Um, so that is one of the reasons. The second is that, as most of the research indicates, financial technology will have an impact across the different sectors of the economy. And therefore, as future managers and as existing managers in businesses, you should be aware of the disruption that financial technology is likely to bring in the different industries. So we are taking an approach in today's webinar that aims to, first of all, explain a little bit what is the concept of financial technology and what are the key technologies that drive this disruption. Some examples of applications of financial technology in different functions within financial services, namely payments, lending and investing. And then towards the end, we are going to reflect on the wider implications of some of the technologies for the society as a whole, and B, on the implications on the different business models. So we are going to take a more managerial approach towards the end, a more strategic management kind of approach towards the end, which is, I would think, is the thing you want to focus more, being aware of the drivers in terms of innovation, strategy development, and so on. So first of all, financial technology, this is the definition from the European Banking Authority. Is one of the many definitions out there. It's calling about financial innovation which is driven by technology and will result new business models, applications, processes, or products that primarily would have an effect on financial markets mainly, and in relation to the provision of financial services. However, as we are going to see, financial services and financial markets are not the only part of the economy that is affected. Now, one common misconception or confusion that exists is between what we call financial technology, or FinTech in short, and financial innovation. These are not the same concepts, mainly because financial technology is a relatively new concept that emerged towards the end of 1960s with the ATMs, the machines that we use to take cash out, and is primarily driven by technology. So is advancements in the way that we provide financial services, which is following some breakthrough in technology. And some examples are the ATMs, the internet, cloud computing, API, artificial intelligence, and blockchain, as we are going to see those in a minute. Although on the other hand, we have financial innovation, which is not the same as FinTech, because financial innovation has been around since the beginning of the world. So financial innovation was back in the days, in the ancient times, when we had the first coins, and then we had the first notes, and then we had the first credit cards, and then we had derivatives, and then we had securities, and so on and so forth. It doesn't require technology. Of course, it's facilitated by technology, but financial innovation could be in the absence of technology. Sometimes is following the development of technology and is following the development of regulatory requirements or changing expectations by the customers. So it's good to be able to distinguish between the two. Financial innovation is not the same as FinTech, in short. Now, to get an idea of how significant is this development, over the past, I'd say, about 5 years, there has been huge development in the investment activity in the area of FinTech. As you can see, in 2014, The total investment at global scale was about 20 billion, and that's dollars. Whereas in the first half of 2018, it was 41 billion. So you can see significant increase in the volume of investment. Another very interesting trend to see here is the number of deals, that the number of deals is going down, primarily because the size of the deals is going up. So you have a smaller number of deals, but a larger number of investment, meaning that now we tend to have larger projects, larger organizations working in collaboration with small fintech startups. So that is the trend. In the beginning, it was primarily startups, early stage startups, fintech, IT driven companies. As the fintech awareness grew, we had the traditional players like big banks. JP Morgan is one example that they decided to collaborate with these fintech startups. So this kind of collaborations started, and therefore this is why you see the drop in the number of deals, but at the same time you see that the volume is going up. And again, you can see that here, that if you try to segment the deals by the size, you see that most of the deals now is in the size of $20 million and above that. So in the early days, you were getting smaller deals of about 1 million. So as the market matures, we have larger projects, more traditional players combining forces with startup companies. So that demonstrates that we are entering a phase of growth in fintech, whereas in the past 3-4 years we were in a stage of seed growth, early stage growth. And obviously in the next 5 years we will see this growth being consolidated. Now, if we want to focus on the adoption of fintech in financial services, by looking in the core financial services, meaning payments and money transfers, savings and investment, financial planning, insurance and borrowing, you see the percentage of fintech adoption by core financial service. The number one, as you can understand by the things you do in everyday life, is payments and money transfers. Examples, PayPal, even the contactless cards is an aspect of fintech in essence. So in comparison, in 2 years' time, you see that we had a massive increase between 18% and 50%. So 50% today of all money transfers and payments are done through an application of fintech. So that's really, really, really important. Another great development is the adoption by insurance of fintech applications. Back in 2015 was 8%, whereas in 2017 is 24%. Savings and investment 20%, financial planning less, and borrowing about 10%. But again, it's growing. In terms of where fintech is taking place, China, India are driving this revolution. China with 69% adoption of fintech in financial services, India 52%. That's primarily because of the strong human capital that is existing in these countries to support that. People with IT skills who work on developing new applications within the fintech space. UK, not that bad, 42%, same as Brazil, and then the rest of the countries. But as you can see, most of the countries are in the area of minimum 30%, I would say. which is again a sign that the average adoption is 33%. So 1 in 3 financial services is provided by a fintech application. Now let's turn into the key technologies, which I think this is really important for you as managers to understand what drives this fintech revolution. The reason why you need to understand about the key technologies is A, to be able to understand the disruption that this is causing to your existing markets, and B, if you are looking to innovate and create a new venture within that space, you need to understand the technology, because otherwise it's not possible for you to think about new ways to provide an existing product or to provide a new product. Now, there's an abundance of technologies around fintech. I have selected the ones that I believe dominate the space and cover about 90% of the applications in fintech. The first of these technologies is what we call the application programming interfaces, or the APIs. Now, what is that? This is an interface whereby a system of a company is accessible by someone else who is using that to build an application using the code and the customer details from the system of that company. Let me give you one example. One example is if you try to log into any website, it gives you an option to use your Facebook credentials to log in, or your Google credentials to log in. You don't have to create a new password. That's a form of API. Is using the database of Facebook to validate your identity. That's one example. Another example is when you are searching for hotels in booking.com, or when you are searching for flights in Skyscanner. Skyscanner is the interface, but at the background is having access to the booking systems of the different airlines through an API. So this is more or less how it works. So is access to different systems of different companies for the purpose of gathering information and then providing the customer with the final result. Really innovative aspect, and one of the developments that emerged in the past 2-3 years is that now in the European Union, all banks are obliged by law to make their APIs available. So we call that open banking. So the open banking system is a system that obliges all banks to provide access to the APIs, so that to allow customers to compare the different rates and the different services. So that encourages developers to build, let's say, an application whereby they can collect information from the different banks, and they can compare rates and then offer a table of comparison to someone, let's say, who is looking to get a mortgage or a credit card and so on. But that would be at a massive scale, at a European level scale. So that's one example. The second technology, which is one of the major ones, is the artificial intelligence, the AI, as we call it. And within that, you have what you know as machine learning and predictive analytics. Now, this is not something new, surprisingly. Some people think that artificial intelligence is something totally new. It's not. In fact, it's been around for many, many years. It's been a development that goes together with the capacity of computing to process information and the access of data. So machine learning, in fact, is something that has started taking off in the 80s and continued to do so until the 2010, at the end of 2010 that we are now. And we are moving now to what we call deep learning, which is the more advanced form of machine learning. In essence, what this does allows us to process and analyze information so as to make sense out of them, and to predict different outcomes. One example is by looking at the different data, we would be able to identify customers whose loans are more likely not to be serviced. So most likely we would be able to use AI to predict someone that is going to default on a loan, and therefore uh, try to avoid that and minimize the risk. So overall, the way it works is analyzing data to try and find patterns and trends through different algorithms. And of course, the benefit of that is that we are able to do that at the speed and cost and accuracy, which is much better than what we are getting if someone, a human being, was to do that. Now, the techniques that we use for that is nothing different to what has been already out there for many years. The technology is driven by traditional statistics, calculus, and probability theory, but it gained momentum, and we are able now to do things differently and at scale because two things have happened. One is the adoption of the internet, and two is this open data movement, whereby we have now massive amounts of data readily available to us. And at the same time, we have the adoption of mobile devices that allow us to collect data. So this massive amount of data uh, has become available because we have the devices to collect this data. So for instance, every time you use your GPS or your Google Maps and you go from one place to the other, this data is collected, and someone is using this data to analyze the patterns, say, what day you went to the shopping center and what things you bought through your contactless credit card or through your Google Pay. And in this way, we have massive amounts of data, and we see that there is a trend that, let's say, every Wednesday people go to the shopping center and they buy X number of things at this time of the day. Then marketing-wise, we may want to target that. So that's one example of why AI has emerged and has become so popular. And the final one is possibly what is more known around fintech, which is the blockchain. And intentionally, I've tried not to refer to the Bitcoin because Bitcoin is only one application of the blockchain. And here we're interested more on the technologies that drive fintech. So blockchain or distributed ledger is what the name denotes. Again, this is not a new technology. It's been around for ages. Let me give you a few examples here. So first of all, before I go in and explain a little bit more about blockchain and how it works, is what we are able to do with blockchain. Now, blockchain is a distributed ledger that allows us to share information and validate information with the world. So it's like in accounting. If you are aware, in accounting, we keep accounts and we have a double entry accounting, and we make transactions and we keep them in the books. But these books tend to be kept in the company. Nobody else sees those books unless we do an audit and we publicize the financial statements once a year and so on. If we want to make a correction, we are able to go back and make the correction. We don't have to ask no one. What happens with the distributed ledger is that it works in the same way, but the only difference is that your ledger, your books, are shared with the world, with the entire network. Meaning that if you want to go back and make an amendment to these books, this is not possible. Is possible, but you need to inform all the others. So at every time, that means that at every given point in time, the most accurate record of your ledger is kept publicly. Meaning that by this way, you can eliminate the prospect of falsifying data. So far, if I want to send money to someone, let's say in another country, I rely on an intermediary, a bank, to make sure that 100 pounds has been deducted from my account, and then another 100 pounds have been added to the recipient's account in another country. With a distributed ledger, you don't need that, because the system is set up in this way that the system itself can verify that. And that's the beauty of blockchain. Now, what you can do with that, two examples here, smart contracts and biometrics. So a smart contract is a contract that is in the same way that it works if you set up a contract in a lawyer. You can set up a contract on blockchain that if certain conditions are met, then another condition will happen. So if X, then Y. And you don't need anyone to be there to execute it. So you minimize the cost of intermediaries again. Say that may be your, I don't know, your will, or maybe that we agree that if I am a sales manager and I reach 10% of the sales increase, I will get a bonus of X amount of money. If we set this up in a blockchain, no one would be able to amend that as soon as we release it and it's on the blockchain. We don't need to rely on our ability to keep the contract or then the lawyers to chase the contract and so on. So there's a lot of transparency in that regard. Same in biometric information. We can use voice recognition or fingerprints as we already use. We store this information and then we call this information to verify the identity of a person. Overall, as I said, the distributed ledger is a technology that many consider that is going to revolutionize the financial services, primarily because it is transparent, cost-effective, and it doesn't require the presence of an intermediary. Now, one of the things that I've always found difficult to understand in this kind of presentations, and I've been in many of them about fintech, is that no one is talking about how exactly the technology works. So we are discussing about blockchain and how useful that is, and all the beautiful things you can do with it. But what exactly is blockchain? How it looks like? So in today's presentation, what I wanted to show you is very briefly, obviously, because we are not IT people, but give you a very simple demonstration on how a blockchain looks like and what it does. What are the mechanics behind it? So let me open that in a live mode. So in fact, this is what we call a blockchain. So this is a block, and you have 5 in a row, and this is a blockchain. So it's a chain of blocks. Now the whole thing is that in every block you can store data. The data can be anything. Could be a number, could be a book, could be pictures, could be as long, as short as you want. And that block of data will have a hash that is going to be a signature that is unique for that particular block. So that is an identifier, if you like. And no one can predict what exactly that identifier will be. Now the beauty is that if I change something, so say if I type, hi, this is a test, you see certain things happen. First of all, the hash changed completely. And it will change even if I say delete one letter. Again, completely. So if I type a space, different. So every time you add information, you get a different hash. You get a different identifier. You get a different fingerprint, if you like. So that's one of the characteristics. Second, if I go back, you see here it turned green, and you see the first 4 digits of the hash are 4 zeros. What that means? Well, 4 zeros means that this block has been verified, is a verified block by the network. So different computers, different users have verified the information you added to the block. If I change that, or if I create, let's say, a new block, so assume that this is a new block of information, you see everything is red here. So what I need to do? Well, I need to verify that. So this is not verified. So what I would do, I need to mine it in the same way as you create bitcoins. So the process of the blockchain is exactly that, is mining the information, in fact, trying to find a hash whereby the first 4 digits would be 0 for that number. I don't want to confuse you, but the way it works is that is using processing power to do these very difficult and complex calculations, and it's done it. So this is now a verified block. Now see how it works. It's not enough only to mine this, I need to do also this. Why? Because a blockchain is taking the hash of the previous one, this one, it goes here, and it has a different hash for the second block. So it's a chain of different blocks. So in order for the whole chain to be verified, I need to mine the whole thing. So I'll do that for the remaining, and so on. And so on. So for the fourth and the fifth. It's taking a bit longer, mainly because it's the processing that is more power. So if you want to have, so this is now a verified blockchain. Now, again, if you want to go back and change anything, the blockchain is no longer valid. It has to be exactly, so let's say if I add a full stop, not valid. If I go back, and of course these blocks could also have information, but if I go, let's say, to this block and I add something, this doesn't affect the previous ones because I didn't change anything in the previous ones, right? I'm changing only information here. So if I add anything here, I will mine only this. Similarly, if I add something here, it affects that part of the chain. So in other words, you have a ledger that you store information, you distribute them to the network. So by the time you've done that, everybody in the network has a copy of this blockchain. Everybody can see it. So let's say you cannot go back and change it and try to falsify information simply for your own benefit, because this would not be possible, because everybody else would have the proper copy of the blockchain. So it's a way to democratize information in the way that you are still in control when it comes to security, because you have this hash, this cryptography aspect. So this is how the distributed ledger works. So now imagine that these blocks can store all sorts of different data, as I told you, and the volume of it can be anything. Could be from, say, one full stop to hundreds of thousands of books. So the applications of that are endless, including the Bitcoin. Now, first of all, any questions so far?
No.
Okay. Let me go now to some examples. I have selected, the examples I have selected are from the areas of payments, investment and borrowing, lending, and then the investment from the side of advising. The reason that I've selected those are because the examples we have are ones that we can understand easily. So and the examples I've selected are from companies that we know. There is various examples from companies that you have never heard of. But I think for the benefit of our own presentation here, it's best if we use known examples. Now, the first one is transfers and payments. What we have mainly three things, with the first one being the main one. So the digital wallets is the one that is been dominating the market for quite some time, is the Google Pay, Apple Pay, and PayPal. So it's a sort of electronic function that allows you to make payments through your credit cards that you either store there or you use them in combination. We all use this kind of facilities on our everyday life now. The second one, which is a bit not as known to this part of the world, but very much the case in Asia, in China at the moment, is the use of a social media network to make purchases and payments. WeChat is something that is not as known as it is in China. In this part of the world, it's not as known. In this part of the world, we have WhatsApp, we have Viber, we have the Facebook Messenger, but we don't use as much WeChat. But in China, it's possibly the number one chatting facility at the moment. Everybody's using it. And what they do through that, because the scale of the users is so great, developers have found ways to use that as a channel to sell products and make payments through that. So you can buy a product through your WeChat application and you can pay for it without the need to enter your credit card details and all that. The third one, and another very, very important one, is what we call the invisible banking or digital banking or alternative banking, or banking that you don't need a bank to open an account, and you can do that simply by using your mobile phone number. So for example, Mones and Revolt is two examples here, these two, that you can open a bank account, a proper bank account with an IBAN number, with a short code, with a proper account, and with a card that it will be delivered at your house, at your home address, but without the need of doing all the things you need to do if you go in a traditional bank, like go to the bank, send paper copies, or go there and sign papers and meet people and all that. Plus, in addition, and most importantly, the cost of transactions is nowhere near the one of a traditional bank. For instance, with all of them, but most importantly with TransferWise, which is a company that you can do the same things. You can open a bank account, but also you can transfer money from one country to another with minimum cost. In the old days being a year ago, if you wanted to transfer money from, let's say, UK to, I don't know, Germany through Western Union, For, let's say, £1,000, most likely you would pay something like £50 commission cost. With TransferWise, this cost is down to €2. So it's 48 euros or 48 pounds less from a single transaction. So all these examples have a common characteristic, which is very, very low transaction cost, very, very low, extremely low transaction cost. And at the moment, these are disrupting very, very seriously the area of payments. Now, the second example is on the lending and financing. Here we have mainly two things. The third thing I would say is an emerging aspect. But two things to focus here is the peer-to-peer lending that allows someone who needs money and someone who wants to invest money to come together in a platform, and one become the investor and the other to become the borrower. The benefit of that is that it allows to match better the profiles of the different individuals, and at the same time is more inclusive than the traditional banking system. And I will explain in a minute how this works. Some examples here: Prosper, Prodigy Finance, Funding Cycle, and Choice. The second example here is what we call crowdfunding, that has two aspects: rewards-based and equity-based. Now, rewards-based crowdfunding is possibly what you know through Kickstarter or Indiegogo, which is a company is pre-selling a product and customers are buying that by offering money to the company to develop the product. So you invest and you get products in exchange. The second is equity-based crowdfunding, which is one example here is Seeds, which is a company that allows startups to go public, but not in a stock exchange. Go public in a sense that they put their pitch on the internet, and investors go in and invest money. It could be from any amount, and in exchange you get shares. You get an equity of the company, an equity share of the company. Obviously, the benefit of that is that you become a shareholder, and companies are allowed to crowdfund their operation easily. This company here, Revolt, is one example of a company that has been financed through this platform. And the final one, which again has become very, very popular, however, I will not consider it to be an established form of financing at the moment. There's lots of things happening at the moment, but there's a lot of criticism at the same time as to whether this is a proper way to raise funding, is what we call the initial coin offering, the ICO, and comes under what we call the tokenization economy, which is we use the cryptocurrency idea, and like the bitcoins, we create tokens in the blockchain and we distribute them in the public. So if you want, let's say, to be a shareholder in a new startup company that we are building, we don't issue shares, we issue tokens that will make you a shareholder in our business. Why we would do that? Because the tokens, the advantage is that because they are based on the blockchain technology, we cannot alter them, we cannot create as many as we want, so we are somehow limited in the manipulation of that. So it's a fixed amount, if you like. And in this way, um, they assume to be a good way to distribute value through a network of people. And of course, incentivize investors to invest in startups. The final one is on investing and advising. So we saw that payments and crowdfunding, behind those, the main technology is the internet. In some instances is, I would say, the API. They are sharing information with different companies and different networks. The area of fintech where AI has the most effect and most application is investing and advising, because here we have what we call the algorithmic trading and robo-advising. So in fact, we have the technology playing the role of the advisor, the investment advisor. By looking into the trends of data and using AI, we can provide solutions, investment solutions to investors. And rather than having a very expensive operation of investment managers who would go there and manage a portfolio of investment for, say, for a salary of 100,000 a year, we do the same thing through computers. Some examples here. On the robo-advising, we have two companies, Betterment and Nutmeg. And in terms of algorithmic trading, we have the Algo Trader. Now, let me clarify that the first one is not for retail customers. So algorithmic trading is not safe for me to use algorithms to trade, say, 100 shares I want to buy for Lloyd's Bank or a small company or a small investment. It's primarily for institutional investors who want to modernize their operations. So rather than having, let's say, 100 people acting as traders, they would use algorithmic trading facility to do all that. So that's for wholesale customers, if you like. Robo-advising is for retail customers. So if I want, let's say, to invest £10,000, rather than going to a traditional investment advisor who will charge me, let's say, 3% of my portfolio value per year to manage it, I will go to one of these companies who will charge me 0.1%. So again, the cost is really, really low. A most recent trend is what we call social trading, whereby we use a social network kind of idea to bring together people who are looking to invest, and they have their ideas about different investments, and we ask them to contribute their ideas to the network. So by doing that, we exchange information. So Vitter is a crowdsourced stock rating company. What it does is asking every member to provide some predictions about, let's say, a share, whether the share will go up or down in the next 6 months and what price that will be. And in this way, by gathering all this data, they get the idea of the trend in the different securities. Very, very interesting idea that, in my view, we will see more of that in the years ahead. Now, let's go into the wider implications, which I think is the most important ones. First of all, I mentioned before in the crowdfunding example that the traditional banking tends to exclude many people. The reason is that in the traditional banking, the way it works is that we tend to have savers who are risk averse. So in order for you to go in a bank and deposit your money, you are someone who doesn't want to take any risk. You want to make sure that your money is going to be there. And then you have borrowers who are also low risk. Is that a phrase that banks tend to lend those who don't need the money? Because in order to, to be approved, you need to have all the credentials and you need to have a good credit score and so on. So a large proportion of the public is excluded by the traditional retail banks. And we call those the unbanked or the underbanked. And there is a term called financial inclusion, which I suggest you to have a look because it's a very, very interesting topic. It's been one of the main priorities of the World Bank. You be surprised, but you'd be surprised that only 69% of the world's population has a bank account. And in fact, if we look to countries like in sub-Saharan Africa, the percentage of people who do not have a bank account is quite substantial. Is 3 out of 4 people in sub-Saharan Africa don't have a bank account in 2011, and that went down in 66% in 2017. So about 1.5 billion people in the world don't have a regular access to a bank account. And again, most important, half of those are women in poor households in rural areas, meaning that a very large proportion of the world's population doesn't have access to the traditional banking system. And this population is the one that actually needs the access the most, because we know that access to, a bank account is one of the prerequisites for economic growth and social mobility. And this is why the World Bank has set as one of the priorities to tackle that. And they use fintech as a way to do it. Why is that? Because fintech, what it does is having a different model, which is what I have on the screen now. So through the alternative platforms, you match the profiles of the savers and the borrowers. So in the examples I've demonstrated earlier, if you go in one of these peer-to-peer lending platforms and you want, let's say, to invest, one of the things they ask you is, okay, how much risk you want to take? Because then, depending on the risk, they give you an interest. If you want to borrow, they ask you the same. They ask you questions and try to identify what sort of risk you have in order not to repay the money back. And accordingly, they come up with an interest rate that you are going to borrow. So you have a matching of profiles, and in this way you achieve better inclusion of people in the system. Plus, with the use of alternative banking services like the ones we demonstrated earlier, TransferWise, Monese, and all that, you can allow people to open a bank account without having to go to a physical bank to visit a bank. Or they can use their mobile phones to pay through other means. So financial inclusion is one thing. The other thing is the impact of blockchain across the different sectors of the economy is not only the financial services, as I said. Imagine blockchain being used to store public records and manage public records. It will reduce the paper to a minimum, and it will improve the accountability and the quality of the information. When it comes to charities, if we want to track where the money from the charities are going when it comes to expenses and all that, having a distributed ledger is the most transparent way to track that. So that's another application. And that's only 2 of the 42 examples included in this link I have down here that you can visit later. Is very, very interesting. it outlines 42 industries and the effect of blockchain could have on them. Now, key emerging themes from all that. First of all, it will be what we call a streamlined infrastructure. When it comes to infrastructure, both in terms of IT, but also in terms of the business infrastructure as a whole, we are looking in a leaner, more streamlined infrastructure. Not to mention, for instance, that blockchain has an impact on the supply chain process of manufacturing. So you don't need to have, say, so many and so large warehouses. If you try to simplify the process of ordering and delivering raw materials, you can achieve a more efficient way to manage your inventory. Second, we are going to have an automation of high value activities. No need to have human involvement in several of the activities that we consider today as being must being taken over by humans. That being servicing of clients, dealing with complaints, even when it comes to legal advice. So there's some applications of AI replacing lawyers these days. Reduce intermediation, that's especially the case in financial services. We gave several examples. We're going to see a reduction in the role of banks, traditional banks, and this is why we see them struggling to maintain their margins these days, because they're under pressure, and this pressure will continue. Fourth is the strategic role of data, really important. Data becomes really precious, really valuable for organizations. In terms of products, we're looking for niche, specialized products. And the final one is, and possibly, again, the most important one here, is customer empowerment. We call that hyper-personalization. And I think that explains the trend very nicely. Customers are the center, because now the customer can decide and can execute a service using a mobile device, and can switch also between services instantaneously. Key drivers. Obviously, fintech will drive the new business model, not in every industry, but at least in financial services and in many other industries. Sharing economy will be embedded in every part of the financial system. That is the case. Blockchain will continue to disrupt. Digital becomes mainstream, and by digital we mean anything that has to do with mobile devices and the internet. Customer intelligence will be the most important predictor of revenue growth and profitability. So analyzing data in relation to your customers is the #1 driver to create the typical sales budgets. The public cloud will become the dominant infrastructure model, and then aspects in relation to security and cybersecurity will be at the top of the agenda, especially for financial institutions. In terms of the focus on the different regions, Asia will emerge and is already emerging as the key center of the technology-driven innovation. And regulators will turn to technology as well. I would say that they have already done so, and regulation these days, regulation and compliance plays a major role in every organization, and not only in financial services. That is in relation to data collection, information management, data protection, and all that. And for the end, I have the business models. So if, let's say, you want to survive in this world and you want to steer your company in avoiding the problems of disruption from this, what you could do, or if you are looking to innovate in that space and create a new venture, there's certain things that you can adopt. A, revolutionize the economics of the market, either by offer a paid for service free of charge, and why you would do that, to gain momentum and to gain customers and to scale up. B, offer a significantly cheaper service, which is what most of these examples we demonstrated do. Again, TransferWise is one example here. The other approach is create something new and compelling. So provide a new type of service. Of course, this requires significant investment and innovation. So that requires radical innovation or significantly sizable incremental innovation that will move well beyond the existing products. And the other way to compete in this environment is to distribute across an existing customer base, which is what many of the startups are doing at the moment, especially in collaboration with the major banks I mentioned earlier. So solve a problem of another business and collaborate with businesses that have an existing customer base. So a fintech startup in London developing, let's say, a very sophisticated way to analyze the stock market, what are the chances of being successful if there are 2-3 people in the entire company and looking to acquire, let's say, 10,000 customers in the next year. The best way for them would be to collaborate with an existing investment bank and offer this service to them. They gain access to an existing customer network, and in this way they capitalize their expertise and abilities. So these are the three ways that within this space of fintech, someone could use to innovate and compete. You don't have to use financial technology and focus on financial services to do that. But going forward, I think these are common trends that will impact the market as a whole, and this is why today's topic was relevant to you. It's not simply for the sake of fintech and financial services. It's mainly because that somehow replicates similar dynamics that happen in the economy anyway, especially that aspect of hyper-personalization that I mentioned. So I think that's all. Been a bit over time, but I'm happy to stay on if we have any questions.
No questions from me, thank you, Evangelist.
Okay. Thanks a lot for your time and for your patience, and I hope to see you again soon.
Yeah, thank you very much.
Yes, thank you.
Great, thank you.